Understanding indices and ETFs, what they are, their pros and cons, and how to trade them. Introduction. Investing in financial markets can be a daunting task, especially for beginners. With a plethora of investment vehicles available, it's crucial to understand the various options to make informed decisions. Two popular choices for investors are indices and exchange-traded funds, ETFs. This article will delve into what these financial instruments are, their advantages and disadvantages, and how you can trade them. What are indices? Indices, also known as stock market indexes, are statistical measures that track the performance of a specific group of assets, usually stocks. An index provides a snapshot of how the overall market or a particular sector is performing. Some of the most well-known indices include the S&P 500, Dow Jones Industrial Average, DJI, Nasdaq Composite, and the C100. How indices work. An index is typically calculated by taking the weighted average of the stock prices of the companies it tracks. For example, the S&P 500 index tracks 500 of the largest publicly traded companies in the U.S., providing a broad view of the American stock market's health. Indices can be based on various factors. Market capitalization. Some indices, like the S&P 500, weigh companies based on their market capitalization. Price-weighted. The DJI is a price-weighted index, meaning companies with higher stock prices have a more significant impact on the index's performance. Sector-specific. There are indices that focus on specific sectors, such as technology, healthcare, or energy, offering insights into particular industries. Pros and cons of indices. Pros. 1. Broad market exposure. Indices provide exposure to a wide range of stocks, reducing the risk associated with individual stocks. 2. Benchmarking. They serve as benchmarks for investors to compare the performance of their portfolios. 3. Historical data. Indices have a long history of data, making it easier to analyze trends and make informed decisions. Cons. 1. Lack of flexibility. You can't invest directly in an index. Instead, you must invest in a fund that tracks the index. 2. Market-weighted bias. Indices like the S&P 500 are market cap-weighted, meaning large companies dominate the index, potentially skewing its performance. 3. Limited to specific markets. Indices focus on particular markets or sectors which might not represent the global economy. What are ETFs? Exchange-traded funds, ETFs, are investment funds that trade on stock exchanges, much like individual stocks. An ETF holds a basket of assets, such as stocks, bonds, or commodities, and its value fluctuates throughout the trading day as it's bought and sold. ETFs are designed to track the performance of a specific index, sector, commodity, or asset class. How ETFs work. ETFs combine features of both stocks and mutual funds. They are traded on exchanges, allowing investors to buy and sell them throughout the trading day. ETFs are often designed to mimic the performance of an index, such as the S&P 500 or the Nasdaq 100, but they can also focus on specific sectors, commodities, or strategies. Types of ETFs. Index ETFs track the performance of a specific index, like the S&P 500 or the FTSE100. Sector and industry ETFs focus on specific sectors like technology, healthcare, or energy. Commodity ETFs track the price of commodities such as gold, oil, or agricultural products. Bond ETFs invest in a basket of bonds, offering exposure to various types of fixed income securities. International ETFs provide exposure to markets outside the investor's home country, such as emerging markets or developed markets. Thematic ETFs focus on specific investment themes like renewable energy, artificial intelligence, or cybersecurity. Pros and cons of ETFs. Pros. 1. Diversification. ETFs provide exposure to a broad range of assets, reducing the risk of investing in individual securities. 2. Liquidity. ETFs trade like stocks, so they can be bought and sold throughout the trading day at market prices. 3. Low costs. ETFs generally have lower expense ratios compared to mutual funds, making them cost-effective for long-term investors. 4. Transparency. Most ETFs disclose their holdings daily, offering transparency to investors. 5. Tax efficiency. ETFs are often more tax efficient than mutual funds due to their unique structure. Cons. 1. Trading costs. Although ETFs have low expense ratios, frequent trading can incur transaction fees and reduce returns. 2. Market risk. Like any investment, ETFs are subject to market risk, meaning their value can fluctuate based on the underlying assets. 3. Tracking errors. Some ETFs may not perfectly track their underlying index, leading to small discrepancies in performance. 4. Complexity. The vast array of ETFs available can be overwhelming, making it difficult for investors to choose the right one. How to trade indices and ETFs. Trading indices. While you cannot directly invest in an index, there are several ways to gain exposure to them. 1. Index funds. These are mutual funds or ETFs that track a specific index. For example, the Vanguard S&P 500 ETF VOO tracks the S&P 500 index. 2. Futures contracts. Investors can trade index futures, which are agreements to buy or sell the index at a future date at a predetermined price. This is more suitable for experienced traders. 3. Options on indices. Options give investors the right, but not the obligation, to buy or sell an index at a specific price before a certain date. Trading ETFs. Trading ETFs is similar to trading stocks, and the process involves the following steps. 1. Open a brokerage account. To trade ETFs, you'll need a brokerage account. Online brokers like Charles Schwab, E-Trade, and Fidelity offer platforms for ETF trading. 2. Research ETFs. Before investing, research the ETFs that align with your investment goals. Consider factors like expense ratios, underlying assets, and historical performance. 3. Place an order. Once you've selected an ETF, you can place an order through your brokerage account. You can choose between a market order, buy or sell at the current price, or a limit order, buy or sell at a specific price. 4. Monitor your investment. After purchasing, keep an eye on your ETF's performance and make adjustments as needed. ETFs offer flexibility, so you can buy and sell them throughout the trading day. Tips for trading indices and indices ETFs. Understand your risk tolerance. Both indices and ETFs involve market risk, so it's essential to understand how much risk you're willing to take on. Diversify your portfolio. Don't put all your money into one index or ETF. Diversification helps spread risk across different assets and sectors. Stay informed. Keep up with market news, economic indicators, and changes in the sectors or assets your ETFs are invested in. Long-term perspective. While it's possible to trade ETFs actively, they are often best suited for long-term investing due to their low costs and tax efficiency. Conclusion. Indices and ETFs are powerful tools for investors looking to gain exposure to a broad range of assets without the need to pick individual stocks. While indices provide a benchmark for the performance of a particular market segment, ETFs offer a flexible, cost-effective way to invest in these indices and other asset classes. However, like any investment, both indices and ETFs come with their own set of risks and benefits. Understanding these can help you make more informed investment decisions. Whether you're a seasoned investor or a beginner, adding indices and ETFs to your portfolio can help you achieve a diversified and balanced investment strategy.